27,000. ADP saying that private payrolls in May rose by 27,000. That's compared to an estimate on the street for this number of 173,000. It is a sharp, I don't know what you want to call it, reversion to the mean from the month of April. 271,000 was that month. That was revised down by 4,000. The goods sector being the primary source of the weakness, down 43,000, but the service sector not doing its normal part of being the major source of a lot of jobs, up just 71,000. And all of this compares to a private payroll estimate for May, which is for the Friday report, of 180,000. We will see, of course, if that number gets revised as the day goes by. The big weakness coming in small business, which we have that next there. Yes, you do. Down 52,000. Again, that was up strong in the month of April. Medium business up just 11,000, also strong in business. In April. Large business up by 68,000. That one was kind of on the weak side in April. So all of this, a lot of this looking like a bounce back or a bounce down from, and looking at by sector, education, health services up pretty strong, 35,000. Leisure, hospitality also good, but it's manufacturing and construction where the weakness is. Now, if you look at a chart and you're driving in your car, what you have is a 271,000 next to a 27,000. So that's like the equivalent, if you want to think of it, like, I don't know, Shaquille O'Neal standing next to Danny DeVito or something along those lines. That's the way you can picture this chart here in your mind. And is it a change of the trend? I will tell you what's happened to the 3-month average of ADP. It has fallen from 216,000 to 152,000. That's the 3-month average that you're looking at, right? That would be of the data you're looking at right there. Andrew?
Okay. Steve, stick around. Joining us right now for more on this number, the ADP number. Mark Zandi, chief economist at Moody's Analytics, the man behind the number. Tell us what it means and tell us what it means for Friday.
Yeah, the economy's weakening. GDP growth in Q2 is tracking close to 1%. Job growth is slowing. This overstates the case. It's not slowing. And I think Steve did a pretty good job. Take last month, this month, take the average. It's about 150K. That's probably where the BLS ends up, around 150K.
But you're saying this understates the case,
or overstates the slowing. Last month, as we discussed last month, overstated the strength.
Overstated the strength.
And this month overstates the weakness. The reality is, growth is slowing, and it's slowing very sharply. Yes.
Maybe this is an unrelated question, but why are your numbers overstating things each time? Generally speaking.
Well, we get the ADP number based on 24 million employees.
Yes.
We have a model. We take the ADP employment number, use other economic data, most notably unemployment insurance claims, and that gives us the BLS estimate. So the BLS estimate is swung by the unemployment insurance claims. That dropped very sharply last month. It jumped back this month. That's causing the numbers to swing. But the reality, the underlying trend, is slowing. The economy's growth rate is slowing significantly.
What industries are getting hit the hardest? I mean, we hear all the time about capital expenditure not being put back in, but where are you actually seeing hiring start to slow?
Well, business capex is dead in the water. It hasn't grown, since the trade war began this time last year, and that's starting to show up in manufacturing. So manufacturing activity is weakening. You saw that in the ADP number. Manufacturing employment actually declined. And if you look at the BLS manufacturing numbers, they've weakened very sharply. So last year we were creating 25, I'm making this up, so it's not exactly right, 25,000 per month in manufacturing. Now we're down to 0 in manufacturing.
And construction's a big deal, too, though.
Yeah, construction, that has slowed, too, but this is overstating the case. Yeah, it's weather-related.
Steve, go ahead.
Yeah, just real quick, take a look at what's happening in the 10-year and the 2-year. The fixed income groups are all declining there in terms of yield. You've had a little bit of come off in the market. What can I tell you? I think this makes Fed rate cuts more likely. I think they'll want to see this number confirmed. They're going to. What's that?
The market should be adding to their gains. No, when it came out, I wondered.
Yeah,
what
Joe, that's a great. Yeah. That's a great dilemma, right? Which is when you look at the prescription that you're going to be given, you wonder, is it exactly commensurate with the illness that you'll have? And I don't know that the market necessarily feels that either. A weakening that's unrelated to tariffs, so you got a weakening anyway, right? And then you have that on top of it. If a quarter or a half a point of Fed rate hikes is enough, I've always maintained, Joe, for 20 years now, the market would prefer growth to Fed rate cuts induced by weakness.